Welcome to Bloomberg Technology. I'm Emily Chang in San Francisco. Stocks slumping to a 2-month low. The Nasdaq tumbling, led by Apple and Amazon. The Fed warning that the economy will need more stimulus to be lifted out of the recession. Fed Chair Dave Powell saying that there's a long way to go before a rebound is even possible. Meantime, Congress has all but ended its attempts to pass another bipartisan spending bill in the wake of the passing of Supreme Court Justice Ruth Bader Ginsburg. The battle to replace her will be anything but bipartisan, and the president says he'll announce his pick on Saturday. Joining us to talk about how the markets are digesting this news, Bloomberg's Abigail Doolittle. So, Abigail, this is not what investors wanted to hear as virus cases continue to tick up, and we got that big 200,000 number in the United States. 200,000 Americans have died due to COVID-19. Talk to us about how investors are handling these continued mixed signals.
Well, that is certainly a very sad headline, a real tragedy here in the U.S. In terms of the impact on the markets, probably not so much. We're still looking at a lot of the volatility and the jitters that's on the backside of that huge rally we saw in August. Of course, August for the FANG index was the best month ever, going all the way back to 2014. And at this point, Emily, the NASDAQ 100 is now basically where it was at the beginning of August. So that froth that everybody was talking about in August that never deserved to happen, according to some strategists, it's now been erased. So perhaps now we're at a level playing field that has, on the day, taken the S&P 500 and the NASDAQ both down more than 2%, the FANG index down 2.8%, and you were mentioning the big drop for Apple, down 4.2%. Again, what's so interesting to stress here from a fundamental standpoint for these individual companies, not much has changed over the last 3 weeks from the euphoria at the beginning of the month, so it really points to technical selling and a removal of that froth. And we're actually seeing a mini version of it on the week, the week so far, Emily. If we take a look at a 3-day chart of Apple, because of course yesterday Apple was up in a big way. On Monday it was up. Net, even with today's big decline, there's Apple up ever so slightly. So that is really a mini version of what we saw in August into September. The big question now is whether the bulls or the bears will prevail. Chris Murphy of Susquehanna just about an hour ago or so ago told me in an interview he thinks probably the bias is to the upside, especially for Apple, based on some of the underlying signals he looks at.
Meantime, Abigail, Tesla shares also tumbling, down 10% today, down 5.5% yesterday on the back of Elon's tweets before the battery event itself. Then Battery Day happened, and it just wasn't as explosive as investors were hoping for. Walk us through the reaction in Tesla shares today.
Well, it's certainly a very bearish reaction, as you were just mentioning, down 10%, that after falling nearly 6% yesterday. So 16% in 2 days, really pretty incredible. Here are some of the outsized movers on the day overall, and it wasn't all bad, Emily. We actually have Twitter up 6% on an upgrade to buy over at Pivotal, a $60 price target, suggesting more upside could be happening. Western Digital, as you know, reorg plan up 6.7%, investors liking it. Oracle, not so much, and the possibility that the TikTok deal might not happen, as China is saying that they may try to kill it because of President Trump's quote-unquote dirty tactics. And there's Tesla, the worst of the worst, down 10.3%. And it really has to do with the fact that, the company just not wowing in terms of this Battery Day. So much anticipation going into the day about what would be announced. A $25,000 electric vehicle, that is exciting, but not until 2023. But here's the real story, Emily. On the year, as we were talking about yesterday, up 355%. Its best year ever since going public back in 2010. So the stock is not only priced to perfection, but it's a case of what have you done for me lately? So talking about a product that's going to come out in 2023, not really satisfying that high valuation. It's important to mention here, though, Emily, Tesla is hanging on to important support. So let's see if those dip buyers can get it together tomorrow or next week. There's some reason to think that that could happen, at least right now.
Right. And of course, shares have soared going into this. Okay, Bloomberg's Abigail Doolittle, thank you so much for breaking that down. Continuing on Tesla now, setting that lofty goal of making a $25,000 car by 2023. The cheaper car will be possible by innovating electric car batteries and cutting the costs in half. This news coming as part of the company's Battery Day, but it did lack the sizzle that investors have come to expect from CEO Elon Musk. To discuss, we are joined by Tasha Keeney of ARK Investment Group. Tasha, what was your overall takeaway on the event? It definitely seemed like some of the executives were coming on a bit, let's say, unprepared.
Well, we're talking about sort of the event lacked sizzle. That's something that I'm surprised to hear from. So from our perspective, I mean, Tesla announced that they're going to reduce battery costs by over 50%, increase range by over 50%, and reduce investment cost on their battery factories by 70%. I mean, these are incredible numbers. And as you know, at ARK Invest, we're long-term investors. So to hear that something is 3 years out, as a long-term shareholder, our time horizon is 5 years out. So again, I think Tesla is changing the way that electric vehicle industry works. And for any traditional automaker to catch up to Tesla now, it seems almost impossible. This $25,000 car that's probably going to have an even greater range than previous models, maybe 400 miles, let's say. I mean, what are you going to do if you're a traditional OEM and you're still kind of struggling to get your electric vehicle program together? Maybe you're even spending investment dollars on other technologies like fuel cells, which we don't think are economic. It's just going to be so hard to catch up to them at this point.
That said, shares down, almost 16% over the last couple of days. So other investors may disagree with you. What are they not getting in your view?
Well, I think, as Abigail mentioned, the stock has had a good run this year, so this could be some pullback. But I do think that there might have been an expectation for a shorter term event. But, again, with a stock like Tesla, it's disruptive innovation. That's why we're long-term shareholders, because if you do focus on the short term, you're going to miss out on those inflection points. The point at which an electric vehicle reaches price parity with a gas-powered car. That's going to cause a dramatic inflection point in demand for EVs, and that's happening in the next 2 to 3 years. So I think again, you want to catch that exponential growth, and you have to look to the long term to do that.
Let's talk about China. Musk touted that the Shanghai factory would be making 1 million cars a year. That is, another quite ambitious proclamation, given that they just got to 1 million cars cumulative. What do you make of that yet another ambitious stretch goal?
Yeah, well, I mean, we've already seen Tesla sort of pull off the impossible in China. So the factory is up and running in less than a year. They're already producing cars. It's the first wholly owned manufacturing facility by any automaker in the country, and they're frankly getting more support from the government than certainly we would have initially expected when they decided to move into that market. So I do think it's definitely been a success story so far. I think that government support is really crucial. I think the Chinese government knows that they want EVs to happen, and they want to let the technology leader in. So we've already seen them get subsidies and a lot of support there. I'm not too surprised to hear that target, especially since Tesla's announcing that now. In their although these changes will happen over the next few years, if they have a path to reducing the investment cost by 70% to build these factories, and then the factories are actually producing a lot more than they were in the past. Last night, Elon said that one factory is basically producing what you would expect 5 to 10 to produce. So I think it's not too difficult, sort of knowing that background, that they would expect again to have a relatively aggressive goal there. And I would say that broadly, something I do think that investors are missing in Tesla is the autonomous opportunity. We've talked about this many times before. It was mentioned a few times on the call last night. Mentioning it because China is one of the largest markets for autonomous driving. So I also think that's really crucial that Tesla has sort of this stronghold there.
Right, and they did say that they would have a full self-driving beta product out soon. Now, what do you think? Look, Tesla's one of your firm's biggest holdings. What do you think the biggest challenges are in terms of meeting your expectations? Like, what are you going to be watching? What's the catch, or what could the catch be?
Well, I certainly think that this goal. So yes, Tesla's our top position. I think that the goal of reaching a fully autonomous driving platform, or completing that, is still really aggressive, because no one's ever done that yet. So I think that right now, it's something that's hard to imagine happening, again, because we just haven't seen it yet. Waymo, Google's project, has gotten pretty close, but they've had a lot of issues commercializing and scaling. So I think that's not to be overlooked. I think, we're talking about stretch goals for Tesla. I think this has always been a stretch goal. They're pulling off something that's incredibly difficult. So that could be, when we look at our valuation for Tesla, we actually only assign a 30% probability to that happening. Now, it's such a large opportunity that it's very much still worth looking at and sort of putting the numbers to. But on the flip side of that, let's say autonomous driving doesn't happen. Our most recent work is looking at what would happen if Tesla were to launch a ride-hailing network with human drivers behind the wheel. They basically do this in order to set up the network for robotaxis anyway, but it could actually be very profitable for them to do so because they have lower operating costs than Uber and Lyft. The cost per mile to drive a Tesla is much cheaper. They could basically take a higher cut of the gross revenues than competitors and potentially pay the drivers better. And we think this could be much higher margins than the core EV business. You could get perhaps a 50% EBITDA margin on this. So that's one sort of, you can think of a risk in the case that autonomous doesn't happen. They still get that recurring revenue model in that case. So we still think there's sort of a way to balance that risk.
All right, Tasha Keeney, always good to have you here on the show. Tasha Keeney of ARK Invest, thank you so much for stopping by. Coming up, more on the ongoing TikTok saga as the company looks to help from a federal judge. Is this the company's Hail Mary? We'll talk about the latest next. This is Bloomberg. TikTok's parent company ByteDance has asked a U.S. court to temporarily block the ban imposed by President Trump. The social media company's deadline to sell its U.S. operations or risk being banned looming in the United States. With us now for the latest, Bloomberg's foreign policy reporter Nick Wadhams on the phone. Nick, give us the very latest. You've got not just TikTok trying to get the courts to do something here, but also Chinese state-run media calling President Trump's tactics dirty and underhanded. Where are we?
Well, over the weekend, there was essentially a real feeling that this deal, the TikTok deal where Oracle and Walmart were going to take about a 20% stake, and there was going to be a lot of protection of data within the U.S., all that was waiting was that the president needed to give his approval. He said he had given his blessing on Saturday, and the assumption there for a little bit was that this was essentially a done deal. In the time since, you have two big things happening. One is Chinese state media. We haven't actually heard officially from the Chinese government, but Chinese state media, as you mentioned, calling into question the deal, suggesting that this is not a deal that China ought to make. And obviously, Chinese media, being state media, don't do that without official sanction from the government. The other thing is you've had these emerging factions within the U.S. government. Bloomberg is also reporting today that Bill Barr, the Attorney General, has some continuing national security concerns. So what on Saturday seemed like essentially a done deal is now seeming a little less so.
Right. And the Chinese government, or at least state-run media, making increasingly hostile statements, does that signify that China is souring on this and won't approve any kind of a sale?
Well, the big question there is how much of this is actually, it has always been how much of this is the national security and how much of this is politics. And what we're hearing out of Chinese state media, I mean, when you hear references to things like dirty tactics, stuff like that, it's really a sign that there's a sense that the president has really overstepped his bounds, and regardless of what the national security implications would be of this, there's a political element to this, too, where the Chinese government has to decide, okay, do we want to do something that President Trump will essentially be able to portray as capitulation? He said, hey, TikTok poses a threat. I am demanding that something be done about this. Okay, we've now arranged for this thing to be done, for Oracle to take a big stake in the company. And so what the president says goes. That does require Chinese acquiescence. So they're now in the process, as far as we know, it's very difficult to get the full scoop directly from the Chinese government, in the process of saying whether that's a political calculation they want to make.
So what is next? The deadline of September 15th has come and gone. September 20th has come and gone. What's the next step?
Well, the big thing was that as part of a series of executive orders that came out last week, essentially the U.S. said, well, okay, if this doesn't happen with TikTok, we will ban it from the App Store. So you will still be able to have it on your phone, but you won't be able to download new versions. You won't be able to get updates. It was believed that when the president gave his blessing on Saturday, that deadline, which comes due in a week or this weekend, that was no longer relevant. Problem solved. TikTok had nothing to worry about. Now, with this deal uncertain and we're still not getting final sign-off, you're seeing TikTok growing increasingly concerned that regardless of whether a deal is in the works, they may still get that ban. So that's why you're seeing an injunction or a request for an injunction today where TikTok is asking a judge to essentially stay that order so that it can continue to be downloaded in app stores.
All right, Bloomberg's Nick Wadhams for us on the trail. Thank you so much for giving us that update. Meantime, Cisco's chair and CEO Chuck Robbins told Bloomberg's Cynthia Coons at the Bloomberg Equality Summit that the company will increase the number of black employees and leaders, adding its name to a list of technology companies promising to fix the lack of diversity in their ranks.
The things that have occurred in 2020 that have led to such a list of actions and this outrage and this focus on social justice, I think, have just given us more energy. It's unfortunate, but it's given us more energy to actually continue to make progress on this. And we're having a broader discussion with our entire employee base, and I think it's been very constructive. So we have a long way to go.
Cisco's Chuck Robbins there. Facebook squashing its second misinformation campaign in a month related to the upcoming presidential election. This one, however, was also aimed at distributing Chinese propaganda across both Southeast Asia and the United States. More on the Chinese operation next. This is Bloomberg. Facebook says it detected and removed a small-scale network of fake accounts aimed at distributing Chinese propaganda across Southeast Asia and the United States. The accounts also pushed messages for and against President Trump, his Democratic opponent Joe Biden, and former Democratic presidential candidate Pete Buttigieg. For more, let's bring in Bloomberg Tech's Sarah Fryer, who covers Facebook. So talk to us about this Chinese foreign interference operation. How big a deal is this?
Well, it's just another example about the size of the amount of interest that there is in the upcoming presidential election, including by foreign governments. This is nothing on the scale of what Russia did in 2016. Only a few 100,000 people saw these posts. However, it does indicate that Facebook is going to have to keep playing whack-a-mole to prevent these things from becoming a big issue ahead of the election. They just have to be constantly vigilant.
So what do we know right now about the scale of foreign interference versus domestic interference?
Well, I think it's safe to say that the foreign interference problem is one that Facebook has very clearly defined and knows exactly what they're going to do to halt. They said that they are especially concerned with content that comes from people who are pretending to be somebody else. That's what Russia did in the 2016 election. People posing as Americans when they're not Americans, or doing the same in other countries. However, the people who are using their real identities to mess with the election and who are, spreading conspiracy theories domestically are a factor that Facebook hasn't quite figured out how to deal with, and they have very vague policies on. You've seen that in the way they've handled misinformation, including from the president, that they have been hesitant to remove voting misinformation. Instead, they're putting a label on it to say, to give resources that they're in their election information hub. So a lot of people have criticized that and says it doesn't go far enough to protect us from the kind of confusion that they expect after and during the election.
Meantime, Andy Stone in Facebook Communications tweeting earlier today that Facebook will be rejecting political ads that claim victory before the results of the election have been declared. Facebook has already said they won't take new political advertising a week ahead of the election. What do you make of this?
Well, the big question is declared by who? When all the votes are tabulated, that could take a long time. So I think it's going to be very difficult for Facebook to sort out this misinformation. One thing we've been thinking about here at Bloomberg is, what happens if there's an opinion? It's not clearly somebody declaring victory, but somebody saying I won. It's clear to see. It's my opinion. Or I'm sure we won. There are so many ways that this could be vaguely interpreted. There's a lot of wiggle room there. So I hope that there is even more clarity to come from Facebook about how they're going to protect us from the kind of misinformation that's already starting to flow on their platform.
Now, last quick question, Sarah. The Verge, Casey Newton did a big piece today about leaks coming from Facebook employees of internal meetings. I know that a number of employees have also spoken to you, have leaked similar information. This seems to be a more becoming an ongoing trend, and I wonder if it's a sign that all of these external issues are having a negative impact on Facebook culture. We have about 30 seconds.
There absolutely is a lot of tension internally at Facebook right now, and in fact, the company has been trying to reduce the amount of vitriol in the networks, but the same people who believe so much in the open speech of social media and the posting are doing it internally in their workforce. It's so different than maybe where we work.
All right. Sarah Fryer of Bloomberg Technology and Issue will continue to follow more of Bloomberg Tech after this quick break, talking Peloton. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Rising geopolitical tension between China and the United States have led to rocky cross-border deals, including the ongoing TikTok and Oracle saga. Bloomberg's Sonali Basak spoke to Michal Katz, head of America's banking at Mizuho Securities earlier today, about how investors are approaching deal flows and M&A in the tech sector.
More proactive intervention or scrutiny, I should say, and that the rationale being national security or critical infrastructure. The person sitting in the White House clearly has a prerogative and ability to do that. I do think that is clearly a factor in when companies are making a determination as to who a potential acquirer may be, because that creates uncertainty as to the possibility of the transaction not getting to the finish line.
Now, I want to draw on your experience as a longtime technology banker here for a minute, because there is so much scrutiny from Washington when it comes to these big tech firms. When you look at that scrutiny, what concerns you most about how it might impact investor flows or M&A activity?
I think the answer is all of the above. I don't think in terms of investor flows that clearly, again, I go back to a fundamental belief in the market opportunities and players positioning and ability to capture that opportunity. And I think investors look at that when they, as well as the operating profile, obviously, as to whether to get into a particular stock. I think I'm not an asset manager and clearly not providing advice on that. But to me, I do go back, whether it be M&A or investment, you got to go back to the fundamentals. Intervention, can make sense to the extent that you are protecting consumer rights, to the extent you're protecting competition. However, you need to balance it with ensuring that companies can be innovative, agile, pursuing new opportunities. So it is, at the end of the day, it is a game of balance and ensuring that you're protecting the respective interests.
But will some of the scrutiny stop some of these big technology firms from getting bigger by means of M&A? I know we're seeing a lot of them hold a lot of conversations, but is there a limit to how big they can get through mergers?
I think it's very company specific, and I think it's sector specific, because the whole concept of being competitive really does depend on the size of the market opportunity, the level playing field, and so it's hard to kind of use kind of, a broad stroke and basically say that's going to determine whether to transact or not.
So we do have a couple of listings next week that are pretty novel. Palantir, Asana are both doing direct listings. Now, given that Mizuho is trying to enter the ECM world in a bigger way, do you think that those models will be the model of the future?
It's a great question. And someone asked me similarly a question around SPACs. Are they going to be disrupting? I do believe that you're going to get this hybrid scenario where you are going to have the traditional vanilla IPOs. You are going to have situations where companies decide to debut into the market via SPACs, and others will do so via direct listing. And so time will tell as to whether direct listing companies are going to be able to attract the anchor investors that typically you spend the time during a roadshow trying to develop this fan club during your traditional IPO. And so time will tell as to whether investors that come in early days are actually accumulating positions or able to build their, not just build their position, but, stay with the company for the long haul.
Michal Katz there, head of America's Banking at Mizuho Securities, with our own Shonali Basic. Well, in a bizarre turn of events, Amazon has denied a partnership with Echelon in the making of the Prime bike, which was touted as a rival to cycling sensation Peloton. The product was promoted by Echelon earlier this week as a collaboration with Amazon and was listed on Amazon's website for $500. The e-commerce giant told Bloomberg late Tuesday it is working with Echelon to change the branding and stop the sale. Echelon has said it was simply a miscommunication. For more, I want to bring in Bloomberg's Mark Gurman, who has been following this story. So, feels like it had to have been a lot more than a miscommunication if Amazon was indeed not involved at all in collaborating on this bike. Mark, what actually happened here?
Yeah, I have to tell you, this is really not terribly surprising to me. I mean, I know Walmart had a similar situation with Echelon, that same bike with the different Walmart branding. I see all the time these smaller companies try to say they've collaborated or worked with a bigger company, whether it be Apple or Amazon, to try to, gain more interest in their product. Amazon, as you know, has their new Alexa devices and services launch event on Thursday. So it felt odd to me if this was an actual Amazon thing, why not save it for Thursday? So to me, it sounds like Echelon just, went a little too far in explaining their relationship with Amazon. The collaboration probably came down to, Amazon selling it on their website. And I can see why Amazon could be pretty upset with the Prime naming and them playing up this partnership and come out and deny it so, flatly.
So Echelon in a statement saying this product was built by Echelon to sell exclusively on Amazon. We're working to rebrand the product and get it back up for sale as soon as possible. Amazon saying this bike is not an Amazon product or related to Amazon Prime. We don't have a formal partnership. That said, I wonder if the marketing here actually accomplished what Echelon was hoping for, because this got a lot of publicity.
Absolutely. I'm sure tons of people bought this bike. You saw what it did to Peloton. Their shares fell nearly 7% Tuesday morning on this news. And maybe the positive here for Amazon is they see there might actually be some interest in such a product from Amazon. I think that if they do it, the communications and the product will probably be a little bit better than this $500 bike from Echelon.
Right. Echelon gave Amazon an idea. That said, do you know how the bike compares to Peloton and to the other options out there? Obviously Peloton has the mind share and the market share at this point, but is there an opening for, up and comers?
Yeah, what you see Amazon starting to do, and they showed this with their health band that they released recently, the Halo, is that they're trying to now sell products at a pretty low cost hardware-wise and then throw a subscription price on top of that. And so I think there could be room in this fitness market, that Peloton is really creating at this higher end for something that's probably maybe half the price or a quarter of the price of what Peloton's offering, and then offering it through a Prime-like subscription. And you can see that Amazon might want to get in that space. They've definitely been playing more in that health arena. The big difference to your original question with the Echelon bike is the lack of that screen, the lack of that interface. And Amazon has years and years, if not a decade, of experience in building user interfaces, Android-based tablets that they could make that would replicate the design of the Peloton and their screen. So, this could be an area that's prime for Amazon to enter. And quite frankly, I think given that their distribution, operations, software and hardware integration, obviously technology prowess, this could be a very interesting area for them to explore. So would I be surprised if they announce a bike on tomorrow? Yes. Would I be surprised if they announce a bike next year, the year after? Probably not.
Your reference to tomorrow, Amazon holding its Devices Day tomorrow, which we will be covering, and we'll see if a bike is on the list. Bloomberg's Mark Gurman, thank you so much for joining us. All right, coming up, the CDC has said Americans can expect a COVID-19 vaccine by April, but will it be available to everyone at the same time? Likely no. We're going to hear from Dr. Anthony Fauci, head of the National Institute for Allergy and Infectious Diseases. Next, this is Bloomberg. Johnson & Johnson has begun a trial of its COVID-19 vaccine with up to 60,000 volunteers, marking the first big U.S. trial that may work after just one shot. The director of the CDC says 700 million doses should be available by April of next year. Meantime, there is growing concern that minority groups may have inadequate access to vaccine trials and the eventual vaccine itself. At the Bloomberg Equality Summit, Dr. Anthony Fauci spoke with Carlyle co-founder David Rubenstein to discuss the country's plans for distribution when the time comes.
Let me ask you about a concern that has been expressed by an op-ed recently in the New York Times about whether people who are minorities are being adequately represented in the COVID-19 phase 3 trials. What can you say about that?
Well, we are trying as best as we possibly can to get equitable representation of African Americans, Latinx, and other minorities. We're doing better with the Latinx, but still we have to do much, much better with the relative percentage of African Americans that are in the trial. It's a good reason for that, David, because when the trials ultimately get shown to be safe and effective with regard to the candidate vaccines, we want to be able to say with confidence that they are safe and effective in all demographic groups.
Now, there's a concern in the minority community, I believe, that when the vaccine is available, wealthy white people will get it first, and then it will trickle down, and the last people to get it will be minorities who might need it better or more than wealthy white people. What can you do to assure people that people of minority backgrounds will be getting this in the same fair way that it should be distributed?
Well, there will be a prioritization. I mean, classically, notwithstanding COVID-19, whenever there is a shortage of vaccine in the sense of when you're rolling it out and you don't have all the doses, classically, the Advisory Committee on Immunization Practices advises the CDC, who makes that determination about what prioritization is going to be done. We're complementing that with another group from the National Academy of Medicine, which has recently met to also give a recommendation. We don't know exactly what the decision is going to be, but I can tell you, David, from past experience, clearly people who can benefit from the vaccine the most and those who are at the highest risk of serious complications will be in the higher priority. Almost certainly, the first priority will be the frontline workers, the people such as the healthcare providers who put themselves at risk. But close behind them will very likely be people who could benefit the most, and almost certainly that would include minorities.
Well, but minorities very often might be in the lower income strata. Suppose they say, yes, thank you for putting me at the front of the line, but I can't afford to get the vaccine. What are we going to do as the U.S. government to make certain that people that can't really afford it will get it?
Yeah, well, that was a very important question, David, and we were at the task force meeting and said, when we get asked that question, will the government make sure that that is not the case, that people who cannot afford it, as it were. First of all, people need to understand the vaccine itself is free. The federal government has pre-purchased those. So the vaccine itself is free. If there's any fee, it's going to be associated with the administrative aspects of administering the vaccine. And that should not be something that gets in the way of poor people receiving it.
Dr. Anthony Fauci there, head of the National Institute for Allergy and Infectious Diseases, speaking with Carlyle Group co-founder David Rubenstein. You can watch more of the Bloomberg Equality Summit right here on Bloomberg Television and Bloomberg Radio. Catch it live on the Bloomberg at Live Go. For more now on the current state of vaccine development, I want to bring in Bloomberg's Riley Griffin, who covers healthcare for us. And I want to start, Riley, with Johnson & Johnson and the possibility of this one-shot vaccine. Where exactly is Johnson & Johnson right now? And by one shot, does that mean one shot forever or one shot every year?
That is a fabulous question. Well, J&J announced today that it was launching a 60,000-person final stage trial of its experimental coronavirus vaccine, which brings it into the fold of only a handful of frontrunners conducting trials in the U.S. in hopes of bringing a shot to market to quell the pandemic. What we know of the other front runners, and you may know their names, Moderna, Pfizer, AstraZeneca, is that they are testing 2-dose regimens in late-stage trials. What that means is a vaccine plus a booster. So what's so novel about this announcement is J&J is suggesting it's only going to test a 1-dose vaccine, a single shot in this late-stage trial. And that will lower barriers when it comes to distribution, but it will also expedite the time it takes to conduct this clinical trial. And Johnson & Johnson lags a little bit. It's a few months behind those front runners. And now it's suggesting it expects to be able to approach U.S. regulators with an emergency use authorization in the beginning of 2021. It will have data on whether or not it's safe and effective as soon as the end of this year. Now, to qualify this, J&J is trying a 2-dose version of its vaccine in Europe. But the importance here, as Chief Medical Officer Paul Stoffels told me just this morning, is that they want to get through trials quickly, and they know that a single dose has shown in early stage studies and in animal models that within 15 days they can get to a level of protection that is strong. And so they've moved forward with that single dose into this large final stage trial to try to get to market a vaccine as quick as possible.
There are some other possible advantages to the Johnson & Johnson vaccine in that it can be refrigerated for longer periods of time than some of the other vaccines. But would you still need to get that single shot every year as the disease evolves, just like the flu shot?
The reality is we don't know the answer to that quite yet because we don't have data that is long-term. We haven't seen results to know how long these antibodies will last. When speaking with Pfizer's CEO, for example, Albert Bourla has told me that it's quite likely will require a flu shot approach to the coronavirus vaccine too. But for the interim, all of these vaccine makers, all of the front runners, their goal is just to see if there's protection whatsoever. The question of how long immunity lasts will come next. And that's why it's important that Johnson & Johnson is simultaneously testing this 2-dose regimen in Europe as it proceeds with the 1-dose regimen here in the U.S.
So quickly, Riley, according to your reporting, what is the time frame, the soonest that a vaccine could actually be available to the mainstream American public? Is it April? Is it late this year? Is it the middle of next year? What are we actually looking at this point?
It's one of the most contentious questions if you ask those in the medical community, because simultaneously you have Pfizer suggesting that it might have data as soon as October, making it possible that America under an emergency use authorization some of those shots before year end. But if you ask broader experts, former FDA commissioners and so forth, when will the vast majority of Americans have access to a shot? The answer tends to be the middle of next year towards the end as well. And so my money goes with them. I'm banking on the broadest amount of the American public having access later next year.
All right. Riley Griffin, who is covering this very contentious and fascinating vaccine development for us. Thank you so much, Riley, for that update. Coming up, Nike crushed its earnings yesterday, with some analysts saying the footwear giant is in even better position now than pre-COVID. We'll talk to one sneaker CEO next on the state of demand and the impact of Kanye West. That's next. This is Bloomberg. The pandemic has taken its toll on a number of businesses, but for some companies, business is getting even better. Nike shares surged today after reporting digital sales jumped over 80%. Joining us now, Eddie Liu, the CEO and co-founder of GOAT, an online sneaker marketplace that is growing as rapidly as sneakerhead culture, and just raised a new round of funding at a $1.75 billion valuation. Eddie, thank you so much for joining us. So obviously that's a huge number. You're raising a lot of money. What is the growth that you're seeing that justifies that?
Emily, thanks for having me. First and foremost, it's a great day here at GOAT. It's a testament to the hard work our teams put in ever since 2015, when we launched the sneaker marketplace based on trust and safety. And since then, of course, we've launched internationally, acquired Flight Club, and launched new verticals such as apparel and accessories. Fast forward to today, in terms of growth, we have over 30 million members, 600,000 sellers, and over 350 brands on our platform, where we're truly fulfilling our mission of becoming fulfilling our mission of becoming a global platform that brings together the world's greatest products from the past, present, and future. And we're excited to bring on D1 on board, especially as we've accelerated growth these past 6 months.
Now, sneaker culture has in part been driven by some specific personalities, and one of them, of course, is Kanye West. And I'm curious, what impact has Yeezy had on the sneaker market, and is that at all being undermined by some of his more controversial statements lately?
Well, when we launched in 2015, that's when Kanye partnered with Adidas and launched the Pirate Blacks and the Turtle Doves. And we were heavily skewed with Adidas, and we saw a lot of sales. But now, actually, on GOAT Group, there's over 100,000 styles that you can choose from. Yes, and you can buy the limited edition rare Yeezys. But what we've seen is that actually over 40% of our sales on GOAT are under retail prices. So we've just become the best place to buy sneakers now, period.
So let's talk about then the competition and Nike crushing its earnings expectations. What do you make of that in a pandemic, no less? And Nike, is that similar to the growth that you're seeing?
Yeah, I mean, Nike's an iconic brand, and we aspire to be a brand just like them. We've actually done a few marketing partnerships with them. So I think it's a very symbiotic relationship between the two. And we're seeing similar growth based on their earnings call yesterday, where digital, of course, is up for us. We're seeing great growth there. And they mentioned Jordans are increasing. And ever since The Last Dance, the Michael Jordan documentary aired, we've seen Jordans increase as well. I mean, the weeks before The Last Dance aired and the weeks after, sales of Jordans increased 76% on GOAT.
So what do you see, what do these numbers tell you about the future of online versus offline sales with regard to apparel and shoes in particular?
Well, we already saw a secular shift towards e-commerce pre-COVID, but post-COVID, this shift and this trend has only turbocharged as shopping in stores is no longer an option for many people. And that's here to stay. What we've seen is it's just people that shop on GOAT, they see how much more superior it is to shop on GOAT versus a traditional retailer. I mentioned that 100,000 unique styles and SKUs that we have on GOAT. Compare that to a traditional sneaker retailer that has about 200 SKUs on the wall. And it's only styles that is this year's styles and styles that haven't sold out yet. Comparing that to GOAT, where we have 100,000 unique styles from the past, present, and future, so someone can get exactly what they want. So I think these types of things are unique differentiations that GOAT can provide for our customer.
It'll be interesting, certainly, to see the impact that AI and VR will have on the retail sector. Eddie Liu, GOAT co-founder and CEO, thank you so much for joining us. We will keep our eye on your marketplace. And that does it for this edition of Bloomberg Technology. Bloomberg Daybreak Australia is next. I'm Emily Chang in San Francisco. This is Bloomberg.